Over the last 12 to 18 months, something really interesting has been happening in the mental health market, and most practice owners don't realize what they're seeing yet. So it's not loud yet, but it is consistent and it's forming a pattern. Now, here's the clearest way that I can put it: the mental health market isn't breaking, it's splitting. And the side that you're on determines how much friction you'll feel in your business right now and over the next few years. This shift isn't theoretical anymore. You can actually see it in the data, in the behavior, and the power dynamics within the market right now. And we're already seeing three very, very strong signals. Now, the first signal is this: insurance-based practices are full, but income is flat. And I want to slow this down here because this part often gets misunderstood. Now, here's what we're actually seeing in real practices. So calendars are full, clinicians are booked 4 to 8 weeks out, wait lists are growing. Now, from the outside, this all looks like success, but inside the business, something doesn't quite line up. Owners still can't pay themselves meaningfully more. Raises for clinicians feel tight or stressful, and the only way to actually increase revenue is to push volume, which means more sessions, more hours, more output, and that is the contradiction right there. So when people say that demand is high, they're right, but demand is not the problem anymore. Leverage is. So here's what this means in plain terms. So leverage is the ability to turn demand into upside, which means higher margins, better clinician pay, more freedom for the owner, and insurance models don't give you that lever. So with insurance, price is fixed. You don't really control it, you don't negotiate it, and you don't raise it when demand increases. So when more people want more care, the system doesn't reward you for that. It just asks you for more output, more sessions, more documentation, more admin work, and more emotional labor. So that creates this very specific kind of trap where you can be fully booked and still be financially constrained. So you could have more demand than ever and still feel stuck because the model only scales by adding load, not by increasing return. So this is why practices feel busy but not profitable. And it's why owners say things like, I'm maxed out, but I don't feel secure. And it's why every growth conversation eventually turns into burnout management instead of actual strategy. So when a model can't translate demand into higher margins, better clinician pay, or owner freedom, that's not a motivation issue. It's not a mindset issue. It's actually a structural issue. And the system is actually doing exactly what it was designed to do. And that's why this is a signal here and not just a one-off case or an anomaly. The second signal is about price sensitivity, and this one is subtle but extremely, extremely important because it's not just that people are paying different prices, it's that they're asking completely different questions. Here's what's happening. There's one group of prospective clients who lead with, do you take my insurance? And there's another group who lead with, how fast can we start? So those two questions come from two very different mindsets, and the gap between them is widening. So the first group is trying to reduce cost. They're navigating constraints, they're comparing options, they're looking for coverage, while the second group is actually trying to reduce friction. They care about speed, they care about fit, and they care about confidence and whether this actually feels like the right solution for them. So that's the difference that matters because it changes how the market behaves. So what we're seeing is a split. The bottom of the market is getting cheaper and louder. So more price comparison is happening there, more shopping around, more urgency around cost, while at the same time, the top of the market is getting calmer and more decisive. They're asking fewer questions, they're deciding faster, and there's less back and forth going on. And this is where people often misunderstand what's actually going on. Now, they assume that price sensitivity is about money, and it's not. It's actually about perceived risk. So people who can afford private pay are actually less tolerant of vague messaging. They don't want to explore options. They want to know, is this built for me? Can you understand my problem? And can you actually help me move forward? So when that is clear, price becomes secondary. This is why positioning suddenly matters so much. When your messaging is broad, general, or indistinct, everyone becomes price sensitive because there's no clear reason to choose you. But when your positioning is specific, outcome focused, and intentional, the right clients stop negotiating and they actually decide. This is classic market bifurcation. So as markets mature, they don't settle in the middle, they actually split. And the models that try to sit in the middle, not cheap, not premium, not clearly one thing or the other, those are the ones that get crushed first. Not because they're bad, but because they're just unclear. So that's what this signal is really telling us. The market is no longer rewarding good enough positioning. it's rewarding clarity. Now, the third signal is about marketing. And this is where a lot of people get uncomfortable because it feels personal. So I want to be very clear about what I mean here. There was an old world where a practice could say, we don't market, we rely on referrals. And for a long time, that actually worked. Referrals were steady, directories were less crowded, and demand didn't fluctuate as much. That world doesn't exist anymore. So here's the new reality. Referral flow is inconsistent. Psychology today is very saturated, and platforms change their rules constantly. So none of that is because practices did something wrong. It's because the environment has actually changed. And what this shift is revealing is something important. So models that rely on external systems for demand are fragile. If your growth depends on referral goodwill, directory algorithms, or platform visibility that you don't actually control, then you're not actually controlling your demand, you're borrowing it. Now, that fragility didn't show up when demand was easier, but under pressure, it becomes very obvious. So a slow referral month suddenly matters, a platform tweak suddenly hurts, and growth feels unpredictable instead of being intentional. Now, meanwhile, something else is happening at the same time. Practices that know their numbers, and I mean really know them, they're in a different position right now. So they know what it costs to acquire a client, they know what a client is worth to them, and they know that they can turn demand on and off, and that is leverage. So this doesn't mean they're doing anything flashy, it just means they've built infrastructure instead of hoping for consistency. So they don't just try ads, they don't guess, they don't wait, they actually build systems that create demand when they need it. And this is the key point. Marketing didn't cause this shift, marketing exposed it. So it showed who already had control and who didn't. In a stable environment, passive models look fine. In a changing environment, only controlled systems hold up. And that's what we're seeing now. And this is why marketing suddenly feels unavoidable, not because everyone needs to become a marketer, but because every business needs a way to control demand instead of relying on luck. Now that's what this signal is really telling us. The market isn't rewarding noise, it's rewarding leverage. So when you zoom out and you look at all three of these signals together, they point to the same underlying truth, and that is that mental health is no longer operating as a service economy, it's becoming a positioning economy. And here's what I mean by that. In a service economy, outcomes are mostly determined by availability. So if you're licensed, if you're competent, if you have open slots, then demand will flow to you. And that used to be enough. Now, in a positioning economy, that's no longer what decides outcomes. Now, outcomes are determined by clarity. So, who you're for, what problem you solve best, and how clearly that's actually communicated. So, this is why we're seeing something that feels confusing on the surface. Is you can have two practices with the same license, the same clinical training, the same years of experience, and one is capped, stressed, and fighting for margin, while the other is calmer, more profitable, and more selective about who they work with. So that gap isn't about clinical skill, it's about business model clarity. So positioning actually determines who finds you, how price sensitive they are, how quickly they decide, and what kind of relationship they expect to have with your practice. So when positioning is vague, everything feels a lot harder. Marketing costs more, clients shop around, price becomes the main objection. When positioning is clear, the opposite happens. The right people self-select in, the wrong people self-select out, the conversations that you're having are shorter, the decisions are easier, and it's not because you're better, it's because you're being clear. That is what a positioning economy does. It doesn't reward effort, it rewards precision. And this is why all three signals matter together. So full caseloads with flat income, splitting price sensitivity, marketing exposing weak models. They're not separate problems, they're symptoms of the same shift. So the market is no longer asking, can you provide the service? It's asking, is this actually built for me? And practices that can answer that clearly are being pulled forward while the rest are feeling increasing friction. And that is the pattern that is forming. Now, once you see it this way, a lot of what's been feeling confusing suddenly starts to make sense. Now, at this point, it isn't really about insurance versus private pay as a preference anymore. It's about which business models are being squeezed by the market and which ones are being rewarded. So first, I want to walk you through the models that are under the most pressure right now. So let's start with insurance-dependent solo practices. Now, these practices, they're not struggling because demand is low. They're hurting because reimbursement rates haven't meaningfully increased in years, while administrative and billing complexities keep climbing. So you're capped on income by payer rules, not by how many people want your help. So even when demand goes up, your upside doesn't. And this creates a very specific experience where you're fully booked, you're busy every week, and yet you still feel stressed and underpaid. And any attempt to earn more means you're seeing more sessions, more hours, or more strain. And insurance, it didn't kill these practices, it just froze them in place while the costs continued to rise. The second model getting squeezed is high volume, low price teletherapy, the race to the bottom of the marketplaces. So these models rely on scale to survive, but scale comes with trade-offs. Client churn is high, therapists burn out quickly, and customer acquisition costs keep rising while retention keeps falling. So these businesses only work at massive scale, and even then, margins are thin and trust is fragile. So when acquisition costs rise or clinician supply tightens, the whole model starts to wobble, and that pressure is showing up right now. Now, the third model under pressure is the undifferentiated group practice. This is the model that says, we do anxiety, depression, trauma, couples, teens, EMDR, CBT, mindfulness, all of the things. And on the surface, that sounds very flexible, but in the current market, it actually creates a problem because when there's no clear why you, marketing sounds identical to everyone else. Your website looks like every other practice, and your messaging blends together. And clients can't tell why they should choose you specifically. So what happens? Price sensitivity goes up because when everything sounds the same, price becomes the deciding factor, right? So sameness actually creates pressure. Now let me walk you through the models that are being rewarded. And as I do this, I want you to notice something. None of these models are working because they're flashy. They're working because they're aligned with how the market now makes decisions. So let's start with private pay, clearly positioned practices. These businesses aren't selling therapy as a general service. They're selling outcomes to a very specific type of person. So they're clear about who they help best, what problem they solve, and why their approach is actually different. So what's working right now looks like this. They're serving high functioning professionals, so people dealing with burnout, nervous system overload, trauma informed care framed in performance and regulation language. They have clear boundaries, premium pricing, and here's the key point. People aren't price sensitive when they believe, oh, this was built for me. So the second category being rewarded is the specialized group practices. And the important distinction here is this. It's not more clinicians, it's more focus. So practices that win in this category are very, very clear about what they do and what they don't do. So trauma only practices using EMDR or somatic work, executive mental health, women's nervous system and hormonal mental health, ADHD for adults with careers. Specialization does a few things at once here. It increases close rates, it raises session value, and it improves clinician retention because when everyone knows who the practice is for, expectations are clear on all sides. Now, the third model being rewarded is hybrid practices. So these are businesses that don't rely on a single revenue stream. They're not dependent on one type of client or one type of delivering care. Common hybrids look like this. So therapy combined with intensives, therapy combined with groups, therapy combined with education or programs, or concierge style access layered on top of care. Now, this structure reduces pressure, it smooths seasonal swings, it lowers insurance dependency, and it reduces burnout risk for both owners and clinicians. And then there's the quiet separator, which is practices that market like businesses. So not aggressively, not noisily, but actually intentionally. So these practices, they know their numbers, they track customer acquisition costs rather than just going off of vibes. They understand audience psychology and they treat marketing as infrastructure, not a side task. And they build trust before the consultation happens. So they don't just try ads, they're building systems. And that's the common thread across all of these models. They're not working harder, they're operating with more control, more clarity, more leverage, and fewer points of failure. And that is why these models are being rewarded as the market shifts, not because they're better clinicians, but because they're better aligned with how the market actually works now. So that brings us to the pattern that's actually forming, which is that mental health businesses are being sorted into two different buckets. We have the ones that are being squeezed, and we have the ones that are being rewarded, with the key points being the ones that are being squeezed are we're seeing low pricing, first of all, high volume, low differentiation, and external control, which means they're getting their clients strictly from insurance or strictly from these platforms. While the ones that are being rewarded, the key traits that are present for these are there's a clear niche, there's premium positioning, they have internal control, which means they have a system that's generating interest, generating clients for them, and there's outcome-driven messaging, okay? So this is about leverage, clarity, and autonomy. Now, this is where a lot of practice owners misread what's actually happening. And this misread is understandable, but it's also dangerous if you act on it too quickly. So when people start to notice this shift, a few very common conclusions show up. So some owners look at all this and they think, oh my gosh, insurance is dying. I need to drop panels immediately. And others think private pay just means charging more and I'm going to lose clients. While some think I just need better marketing. And then the other people are thinking I need more clinicians to spread the load. Now, here is the important thing to understand. None of those reactions are irrational. They're just a little bit incomplete. Where the mistake isn't what people want to change, the mistake is how they think that change happens. So dropping insurance panels overnight, it doesn't fix a fragile business model. It just removes a revenue stream before a replacement even exists for it. And then charging more without changing positioning doesn't reduce price sensitivity, it actually increases it. So better marketing is not going to fix unclear messaging. It just amplifies the confusion faster. And hiring more clinicians doesn't reduce pressure if the underlying economics haven't actually changed. It just spreads the strain. So what these responses all have in common is this: they're reactive. They assume the solution is a single move instead of a sequence. So the practices that are actually winning right now, they didn't make dramatic decisions. They didn't flip a switch and they didn't gamble all of their income. They didn't try to outwork structural problems. They changed the order of operation. So they clarified positioning before raising prices. They built demand control before removing insurance constraints. And they added a growth engine that wasn't governed by insurance rules alongside what already existed, not instead of it. So that sequencing is everything, because when you get that sequence wrong, even the right ideas will backfire. And when you get the sequence right, change feels controlled instead of risky. This is why this moment in the market is a little tricky, because the signals are here and the signals are real, but the correct response, it's not necessarily urgency, it's precision. It's being precise in the next step. So once you see that, the conversation shifts. The question stops being, what do I need to drop? And it becomes, what do I need to build first? And for most practice owners, that's where things get a little unclear. Not because they're incapable, but because no one ever taught them how to build leverage before making changes. So if this video is resonating, it's probably because you can already feel this shift happening, even if you haven't quite been able to put a name to it yet. So you might not be ready to act, but you're aware that something needs to change, and that's actually the right place to be. So if you want to go deeper into this, I actually put together a free training that walks through why insurance-only models plateau, how private pay growth actually works, and what it looks like to build this without blowing up your practice. So the link to that video is in the description below. Watch that next, and I hope this gave you some clarity, and I will see you all next time.